What if I told you it's not too late to change your 2025 tax return? That's right, even though it's 2026, there are many moves you can make today that will increase your refund or decrease your liability. I'm going to cover 16 of those moves in this video. To begin with, let's talk about retirement accounts. A simple one for some of you is a traditional IRA contribution. You have up until April 15th to contribute $7,000 to your IRA for 2025, or $8,000 if you are age 50 or over. Now, if you're going to make this contribution in 2026, you're going to want to make sure you talk to your custodian and let them know that it is a 2025 contribution that you are making. The next is a Roth IRA. Yes, I know, a Roth IRA contribution is not deductible on your 2025 tax return, but you can still make that contribution in 2026 for 2025, and the tax benefits that you'll reap down the road are massive, way larger than the small amount of tax you save by contributing to a traditional IRA. The next retirement plan opportunity for you to save taxes is with a SEP IRA. This is a fantastic one for small business owners. You could be a sole proprietor, a single member LLC, partnership, S corporation, and the SEP IRA contribution allows you to contribute up to 25% of your income from that business. Now, that income is defined differently depending on whether it's a sole proprietorship or a partnership or an S corp, so you're going to want to talk to your tax strategist about this. But the beautiful part about the SEP IRA contribution is that unlike the traditional IRA, which you only have until April 15th to make that contribution, with a SEP IRA, you have all the way until the extended tax deadline to make the contribution. That's up to October 15th. So you've got all that time to earn the money to make the contribution of up to 25% of your income for that prior year, in this case for 2025. Now, there are some limits that apply, so talk to your tax strategist about this, but this is a fantastic tax planning opportunity for those of you with a small business or a side hustle of some kind. The next retirement plan tax savings opportunity for you is if you have a solo 401k. It is too late to do salary deferral, but it's not too late to do an elective contribution from the company. Business owners, bonus depreciation is back at 100%, and this is a great opportunity for you. On an asset that you could depreciate over time, you now can take a 100% deduction in year one. This could be things like equipment, machinery, computers, software, or qualified improvement property, which is improvements to a non-residential building. Did you buy a vehicle this year for your business? Now is a great time to look at your actual expenses and your mileage. The mileage reimbursement rate in 2025 was 70 cents per mile. So if you drove 20,000 miles because you're in sales or you're a realtor, that's a $14,000 deduction. So you're going to want to take a look at how many years do I expect to own this vehicle? What is my operating cost? And could it be the case that taking the mileage deduction might actually be more beneficial than using the actual expenses and writing the vehicle off? Next up is the home office deduction. This is one of those indirect expenses that your business has. That means your business isn't directly paying these expenses, you're incurring the expenses personally, and the business now has an opportunity to reimburse you for those. There's two ways to do this. The first is a ratio of the size of the office to the size of the home. Let's say your office is 10% of the size of your home, you own your home, so you do 10% of the mortgage interest, property taxes, insurance, utilities, lawn plowing, etc. would be an expense as a office expense. The other is to do the simplified method, which is $5 per square foot up to $1,500. So you have a 200 square foot room that you use, you would have a $1,000 home office deduction. And after the year has ended, you can take a look at which is going to work out better for me with regard to the home office expense. Next up is any business expenses that you paid personally. We want to think about things like your cell phone. What percentage of your cell phone bill was used for business purposes? Now is an opportunity for you to characterize that as a 2025 business expense. And anything else that may be on any of your personal credit cards or bank statements that was actually a business expense, now is the time to add those into 2025 to make sure you get that benefit on your 2025 tax return. For real estate investors, we've got a long list. Let's start off with a cost segregation study. You can do a cost segregation study after the year has ended. This allows you to speed up your depreciation by recharacterizing 27.5-year or 39-year property as 5-year, 7-year, 15-year property. Now, by default, when you do this, you would take the 5-year property over 5 years, the 15-year property over 15 years, for example, and that's going to give you a great tax benefit for those years. So that's one way that you could use the cost segregation study. The second way to use the cost segregation study is to combine it with bonus depreciation. Again, the One Big Beautiful Bill Act brought bonus depreciation back to 100%, and that's on any property with a life of 20 years or less. So you can look at your cost segregation study and see how much of your building was recharacterized as 5-year or 15-year property, and take 100% bonus depreciation on all of that. Now, here's a tip for real estate owners. You don't have to do this in the year that you buy the property. You can do it in a subsequent year. Now, there is more work for your accountant to do. They need to complete Form 3115 for a change in accounting method to account for the depreciation that has already been taken, but it is still very worthwhile taking a look at a property that has been in service for a couple of years. At some point, there are diminishing returns because you have to pay for the cost seg study. So we tend to see properties that are 6 years old or older, it's not really worth doing the cost seg study on. But if it's newer than that, it's definitely worth doing the cost segregation study and combining that with bonus depreciation to benefit your 2025 tax return. Next up is the grouping election. This will allow you to hit your material participation standards that are needed, depending on whether you're looking at rep status or some other area of real estate tax law. And by grouping your properties as one activity, it allows you to more easily hit your material participation rules. Next up is the partial asset disposition. This one gets missed by a lot of accountants that are not real estate specialists. So let me give you a simple example. Suppose you have a rental property and the roof is older, and you tear the roof off and you put a new roof on it, and the new roof is $25,000. What an average accountant will do is they'll take that $25,000 and they'll add it to the depreciation schedule, and they'll depreciate it over 27.5 years if it's a residential property, and they'll consider everything to be done, and they'll move on. The problem with that is that you're now depreciating 2 roofs, which is a really bad idea. So you see, the original purchase price of the building included the purchase price of the original roof, which you now don't own because you got rid of it. Instead of adding that second roof and depreciating it over 27 years and calling it good, what you need to do is a partial asset disposition. So what this does is it takes a percentage of that original purchase price of the building that will be allocated to the roof and adjusts for depreciation, and then takes the rest of it as a loss. So in this example, because I've recently done one of those, it was a loss of around $13,000. That was the disposing of the old roof. That's not the cost to dispose of it. That's not the cost for the dumpster, let's say. That's the actual cost of removing the asset and no longer owning that asset, because that asset is now gone. So you're able to take that loss in the year that you do the partial asset disposition. So this is a great tool that we use with our clients to bring some real value to their tax returns as real estate investors. And it's something that you may have missed or not known about on your 2025 return that you can now make sure that you add in. Next up is the de minimis safe harbor rule. This allows you to expense up to $2,500 of items. This could even be small improvements to your property. And let me give you an example of this. Now, there are some rules around this, so you can't use this to write off a major improvement on your property. But the IRS has examples of what this looks like, and here's an example that works for the de minimis safe harbor rule. Let's say you own a 4-unit building and you have a tenant move out and you want to replace those 4 windows with more energy efficient windows. You can't really do it on all the units because you have tenants in the other units, but on that vacant unit now, you're going to replace those 4 windows with brand new windows. You get a bill from the contractor, it's $3,000. That's for the windows and the labor. Now that's over this $2,500, so you would have to depreciate that over 27 and a half years. But your accountant says, hey, make sure you bring me all the invoices for improvements. And your accountant takes a look at it and says, oh no, good news. You can actually use the de minimis safe harbor rule of $2,500 for this improvement that you made to your property. And well, you've done a little bit of research and you say, well, this is an improvement. Those can't be expensed. And it's over $2,500. So how does this work? And that's when they tell you it's a minor improvement because this is less than 25% of the windows in the building because there's a common area as well. So this is a small improvement, and the contractor itemized the invoice. And the de minimis safe harbor rule says it's $2,500 per item on an invoice, and it's 4 windows at $400 a piece, and labor of $1,400, all well below the $2,500. And so now you're able to expense $3,000 of new windows on your property because you took advantage of the de minimis safe harbor rule. The last one for you to take a look at if you are a real estate investor is real estate professional status. Now, most of our clients who use real estate professional status as a strategy are doing so intentionally. They're thinking about it throughout the year. But every now and then we run into a client who has a lot of hours into their real estate during the year. They've lost some money on some rentals. They haven't really thought about rep status. And that's when we can have a conversation with them after year end and say, can you construct a log for us? Do you know you have 750 hours? Like, you're clearly there, and that's more than half of the hours that you did in any type of work? Then in that case, we want to make sure that you get the benefit of rep status on your 2025 tax return. These last two apply to anyone. The first is a change in filing status. We see many clients that file as married filing separately because they keep their finances separate, and that's fine, that's a personal decision. But look at the benefit of filing jointly. If you have children in particular, you can come out way ahead by filing jointly, $5,000, $6,000, $8,000, depending on how many kids, depending on your income. But then you have the dilemma of what to do with the refund or what to do with the liability. And that's where your tax preparer can run a simple report for you that looks at married filing jointly versus married filing separately, and they can use that as a tool to help you divide that refund in a way that makes sense for your tax situation. So you get both the benefit of the increased refund with the ability to split it between the two spouses. The second case where this is very helpful is if you have a student loan repayment plan with the government that requires you to work in a lower income or a rural area, and you have income limits that you have to stay within. And typically this starts off well with people, and then they can kind of lose sight of it. And that's when you might need to switch you from married filing jointly to married filing separately. If that other spouse, their income has gone up and you're not going to qualify anymore, that's the time to make that shift from filing jointly to filing separately. Because we're talking about the forgiveness of student loans, that's a much larger dollar amount than just the benefit of claiming children jointly. So make sure you take a look at your filing status, because you may be able to save a considerable amount on taxes on your 2025 tax return by changing your filing status. The last example is an HSA. The health savings account is a powerful tax savings tool for many reasons. You can contribute up to $8,750. If you're age 55 and up, you can contribute an additional $1,000. And the great benefit of the HSA, well, there are two. The first is that there is no income limit. So no matter how high your income is, you can make a deductible contribution to your HSA. And the second benefit of the HSA is that I like to think of it as an IRA that you can use for current medical expenses. And that's because once you hit retirement, you can take distributions from your HSA just like you would from an IRA. So that's my list of tax changes you can make for 2025 in 2026. Have any questions? Hit us in the comments below. I'd love to see your questions and help you to reduce taxes and increase wealth. Thank you for watching this video. If you enjoyed this content, please hit like and subscribe below. And if you'd like to learn more about how to work with one of the tax strategists at Management Accounting, please hit the link in the description below.